video we're going to be having a look at how the RBA can influence the cash rate through what we call the short-term money market. First of all, it's important to note that the RBA actually has no direct control over interest rates in the economy. So what I mean by that is the RBA don't set the rate that you charge, that you get paid on for mortgages, that you pay for your credit cards or car loans. All of that stuff is set by the individual banks. The only thing the RBA has control over is what we call the cash rate. Their only ability is to control the supply of credit compared to the demand for credit through buying and selling securities in the short-term money market. And we'll talk about that later and what the short-term money market actually means and what the RBA could do to influence the cash rate. First of all, the short-term money market. The short-term money market is basically the financial market where financial institutions deal with each other to settle what we call their intraday transactions. So what I mean by that is if you were to go out and say get a haircut or buy a car or anything like that and paid for it on a debit card, well, that money has to be transferred from your bank account into whoever the bank account is of that car yard or that hairdresser or whatever service you're getting at that point in time. So what essentially happens is the banks are constantly transferring money from one bank to the other. But in order to simplify the process, what essentially happens is all the banks have what we call this exchange settlement account. So the exchange settlement account are compulsory accounts all financial institutions, so all banks, hold with the RBA for settlement of day-to-day transactions between the banks. So anytime there's a transaction between you and another person that's with another bank, rather than the banks transferring the money every single time, they will wait until the end of the day and then transfer the balance of the transaction between the two banks. So there may have been like 50,000 different transactions between the Commonwealth Bank and Westpac, for example. Rather than them shifting money every single time one of those transactions takes place, they will transfer the net amount at the end of the day. That all happens through what we call these exchange settlement accounts that the banks all have with the RBA, and they allow funds to get settled for interbank transactions between one bank and another. So, for example, at the start of the day, all the banks have to have a set amount in their exchange settlement accounts. They all have to be in surplus. So let's say Commonwealth Bank, ANZ, NAB and Westpac have all got that amount at the start of the day. Then suddenly throughout the day there'll be money coming into these accounts and money coming out. So for example, Commonwealth Bank might have $5 billion coming in through the different banks throughout the day. So from ANZ and from NAB and from Westpac and all the other different financial institutions. And so on and so forth. They'll also have money coming out. So for example, I bank with Commonwealth Bank. If I was to buy a car on my debit card, the money would have to be transferred from Commonwealth Bank into, for example, an ANZ or something like that. So at the end of the day, they're all going to have a different balance to what they did at the start of the day based on those intraday transactions with the other banks. Now, the important thing is all of these accounts have to have a surplus balance at the end of the month. They can't be in deficit. Because if they're in deficit, it means that the banks won't be able to pay off all those intraday transactions. So they won't be able to settle the transactions that you have with other banks from a day-to-day perspective for all of their customers. So at the end of each day, some banks are in surplus, they're owed by money other banks, and others are in deficit. What essentially happens is to make sure that all the banks remain in surplus, banks with surplus holdings will transfer some of their money and lend to the banks with a deficit holding. So if you're a bank and you have surplus holdings in your exchange settlement account, so basically you've got money in that exchange settlement account that you have with the RBA, you will earn a rate of interest on that account of 25 basis points or 0.25% below the cash rate. Okay, so at the moment the cash rate is 1.75%. If you keep money in that account overnight, you will get 1.5%. If banks have a deficit holding, they have an option to borrow from the RBA, but if they do that, they will get charged 25 basis points higher than the cash rate. So they will borrow from the RBA at the moment at 2%. So if banks want to keep money in their accounts overnight, they only get an interest rate 25 basis points below the cash rate. If banks have a deficit holding, they have to pay interest 25 basis points above the cash rate. So what essentially happens is, so that they don't have to borrow and lend from the RBA call themselves a lender of last resort. The banks will essentially borrow and lend from each other. So basically what will happen is Commonwealth Bank, coming back to this example, Commonwealth Bank have got $3 billion. They might decide to lend $1 billion to Westpac to settle that intraday transaction. That's what we call the cash rate, the rate that the Commonwealth Bank will lend to Westpac. So at that rate is currently 1.75%. Now, Commonwealth Bank will be willing to lend because if they keep that money, that $3 billion, just in their account, they will only get an interest rate of 1.5%. So they'll get an extra 0.25% by lending it out to Westpac, and therefore they'll make more money. Westpac, on the other hand, would prefer to borrow from the Commonwealth Bank than the RBA because they do it at a lower interest rate. They will basically be able to borrow at 1.75% instead of the 2% that they would get from the RBA. So both banks have an incentive to borrow and lend from each other, and that's the cash rate. The cash rate is the interest rate that in the short-term money market, institutions must pay if they need to borrow funds from each other to keep positive balances in their exchange settlement account. That will happen every single day because there's an incentive for both banks to be involved in that transaction. So surplus funds, therefore banks with surplus funds lend their cash into the cash market to other financial institutions. Banks with deficit funds borrow from the cash market or borrow in the overnight loan market. Essentially, the bank gives money to one another at the cash rate of interest. And essentially what will happen is that the surpluses and deficits should help to cancel each other out, and all banks will be in surplus at the end of the day, which they have to be, and all those intraday transactions will be take place and will be fulfilled. Thank you.